Okay, welcome to another episode of IJS Speaks. This is your neighborhood financial economist, KD Mark. And today is November 24th. It's almost, let's call it 9:48 p.m. Eastern Standard Time. So the Asian markets are underway. And let's go ahead and pop on over to the dashboard. And let's see if we can get some kind of an idea of what the market sentiment is. So looking at the dashboard, I'm looking at the dollar index, 10-year treasury, gold, the S&P 500, E-mini futures, and crude oil. So overall, the dollar has been flat. Looking back about a week. Same can be said for the 10-year treasury. The only charts you see some kind of inflection in are the riskier assets, gold, stocks, and energy commodities. And frankly, it seems like investors have been selling gold to invest in other riskier assets. So gold seems to have taken on the role of a funding instrument in financial markets. So we see persistent selling in gold even on days when the dollar is down. So at that point, the dollar and gold are their correlations are positive and they're moving in the same direction. So gold no longer moves or trades like a risk asset and begins to trade more like a safe haven or liquidity asset comparable to the dollar or U.S. Treasuries. Meanwhile, stocks are making record highs. The Russell, I think, today made all-time high. The Dow, I think, closed or traded closed above 30,000. I want to say. So there seems to be momentum behind risk assets, equities in particular, and the narrative seems to center around enthusiasm of market participants for the Biden administration and the way that it's shaping up with the current cabinet nominations that or cabinet proposals, suggestions that the Biden administration is floating so far. But so back to financial markets, right, where it actually matters. Looking at the chart of the dollar with the sideways movement, okay, I interpret that as a lack of conviction with international investment flow. So in other words, investors aren't moving their money into the United States or out of the United States. So investments are being made in local currency wherever they are without too much cross-border flows. Similar idea with the 10-year treasury. It's been trading fairly sideways. Investors are signaling that they believe the instruments are fairly priced and reflects all available market information. Even though, interestingly enough, looking at the first couple candles at the beginning of trading on in the Asian session, on the 10-year Treasury, the price gapped down. So going into the Asian and European sessions, it would be interesting to see if that momentum that pushed that gap in the price holds, or if we get the typical price pattern after a gap where the price tends to trade backwards in an attempt to close the gap. So that'll be worth looking at as the Asian session progresses, and more specifically as the European session comes online. Specifically for me, because I have I finally got around to opening a couple options positions going into the trading week. I carried forward the futures positions and the spot currency. The spot currency position that I had from the previous week, I was able to do a little bit of trading around the positions, still looking at corn and still looking at the Euro US dollar futures. The Canadian dollar, after a bit of whipsawing, I was able to finally have a profitable trade. So, that being said, I feel like my ability to take a pulse of the forex market needs to be further sharpened. So I'll keep trading the forex market, but more so as a thing to do on the side, and not necessarily as in an explicit pursuit of capital gains. It's more so practicing and sharpening my technical analysis skills, because the markets are so liquid. So yeah, I look at it more as practice. But as far as seeking capital gains, personally, I like the way options are structured, and especially from a money management standpoint, simply because you know exactly what your risk is at the onset of the trade, which is simply what you paid for the option. Compared to spot forex, which I trade, and also futures, which I trade, which simply will erase your balance as long as you let the trade run. So as long as there's money in the account with the futures or the spot forex positions, if the trade's running against you, it'll just keep running, just keep eating up your balance. At least with the options, you know what your max loss is going in. It helps you with your money management. It helps, well, not so much risk management, but at least from a money management standpoint, you can stagger out your trades to improve your odds of success, while limiting, or at least being cognizant of your maximum exposure at any given point in time. So with the looking at the trade book, I mentioned the options positions that I put on. So again, earlier in the day, I was looking at a chart of the S&P 500. It was setting up a breakout. I was able to trade it with a call option on the E-mini S&P 500 futures. It's a very short trade. I was in and out of the trade in maybe 20 minutes, but it was a profitable trade. And then towards the end of the session, going into the overnight, I put on a straddle on the SPY, which is the ETF that tracks the S&P 500, and I did one on gold as well. Well, on GLD, which is the ETF that tracks gold. And the idea behind that is momentum, because in both of those markets there has been momentum in recent days, recent trading sessions. With gold, the momentum has been to the downside. With the S&P 500, the momentum has been to the upside. The approach that I take with the options and entering this type of a market is basically there is already movement in the market, and I expect or anticipate that momentum to continue. So I set an entry point, or I set a trade that gives me both upside and downside exposure, which are, a simple straddle, or in some cases a strangle. And the straddles, if the options are closely priced, then I'll just go with a market straddle, and just to open the position and set my break evens. But if I see the market is moving and there are pricing mismatches between calls and puts, then I will opt for a strangle versus a straddle, where there is some difference or distance between your call strike and your put strike. But same concept. Market goes up or down a certain amount, and one contract expires worth less, the other one hopefully is in the money, and you get to profit from that. Or worst case scenario, the price settles at expiration between your two strikes, and both contracts expire worthless at your maximum loss, which is whatever you paid for both contracts. So, and again, with my options positions, I typically go for short expiration. So the analysis in my mind is good for this trading week. So even though I did not enter the positions until late into the Tuesday session, going into the Wednesday session in Asia, I won't necessarily extend out or look for longer dated expirations. The trade, the exposure, the strategy is to assume the exposure within the trading week and capitalize on that exposure within that week, and be out of the exposure at the end of the week, in order to do your analysis over the weekend and reset for the next trading week. So options trading, at least for my approach, is more tactical than anything else. It's all about basically scalping markets. And I like, for instance, the ETFs, because overnight they don't, well, one, they're a little bit cheaper than doing options on futures, but overnight they don't reprice, even though even though the price of the option of the underlying, the ETFs, will move in some cases, like the SPY or GLD, which they trade 24 hours. The options themselves do not reprice until the New York session is open, and they stop trading at the end of the New York session. So overnight the underlying will move, and at market open, I like to I jokingly refer to it as the instrument going into a jump condition, where you have the options price automatically repricing at market open for the underlying that has been moving overnight. And when it reprices in my favor, it looks good because all of a sudden your portfolio is up 10, 15, 18%, at market open. But sometimes, it goes against you. But again, in anticipation of the price moving and not necessarily the price moving in a specific direction, doing the straddles approach gives you an opportunity to take advantage of price moves to the upside or price moves to the downside. And for the options traders that are into the more layered spreads, similar risk profile, not the same, but similar risk profile for a condor or even an iron condor. Let's call it an iron condor, or even, butterflies are, similar concept, but it's just. So anyway, straddles and strangles, similar concept to an iron condor. I think the only benefit to the iron condor versus just an outright straddle or strangle is just the cost of the exposure. So with these straddles and strangles, you're only buying one call and one put, so you're paying full price for both contracts. The iron condor, you're buying vertical spread, so call spread and a put spread, and you're offsetting the cost of your long exposure by selling an option and bringing in premium to offset the premium you're paying for your long exposure. The downside, of course, is the transaction cost. You just went from 2 contracts to 4 contracts, and in most cases you have to pay a commission on both the buy and the sell per contract. That can eat into your profit margins. So for that reason, I prefer the simpler approach of just a straddle or strangle, less contracts, less commissions. It costs a little bit more in terms of margin, but when I first started, I had to use call spreads. I had to use vertical spreads simply because that's what worked for my money management level at that point. But as I was able to grow my portfolio and my balance, I was able to eliminate the sell side of the spread and just focus on the buy side, and just buy a call and buy a put, and not have to sell one on the opposite to offset the cost. So, but similar approach, basically betting on price movement, maintaining momentum, volatility, either direction, up or down. This morning, looking further down into the trade book, looking at the futures, still looking at corn, still looking at the euro US dollar futures. At the current, I am back to being hedged with my futures contracts. Similar to last Thursday, missed opportunity this morning to liquidate a couple contracts in corn. Had to sit through a pullback. Was late in initiating my hedge, so now I'm looking at a spread between my long and my short positions that just locked in a pretty wide loss. And added to that, the calendar relationship between the long and short positions is so that by holding them, the net exposure is negative. So it's like there's a carrying cost of holding that hedge. So, yippee. That's on corn. The euro's it's really relatively flat. Similar concept. I entered with a trailing stop loss overnight. Also last night entered with the euro US dollar futures and the Aussie dollar US dollar spot forex. Entered both with a trailing stop loss. Set the trailing stop losses to enter the positions before going to bed. Overnight, the euro US dollar futures was triggered. The Aussie US dollar spot was triggered and subsequently stopped out because it just kept moving against me. The euro US dollar futures didn't. So when I woke up, position was down. I was able to initiate a hedge, locked in a loss. Fortunately, the relationship between the long and the short positions is so that there is a carrying gain. So for holding that spread, the difference is positive, and it's like earning interest for holding the spread. Not as much as I'm paying on corn, so it's not an offset, but they just happen to run opposite. The last derivative contract or spread that I have, the 10-year Treasury, that gap, I'm really interested to see how that reprices with the options, because it doesn't seem like the options price are reflecting the change in the underlying, which is weird. Maybe a market timing thing, maybe just because of the trading session that is, or maybe the illiquidity of the contracts could be lending a hand in that. But as the European session rolls on or comes online, and then we roll into the American session, I'm interested to see how those contracts reprice, as well as, of course, the option spread on the SPY, which is currently in the money, but the options again do not reflect that with their pricing, as they will not trade until New York opens in the morning. And after the last trade in the US dollar Canadian dollar exchange rate, I have not initiated any other spot currency trades. I am looking at the commodity complex of the dollar Canadian, Aussie dollar, US dollar, New Zealand dollar, US dollar, and really looking to see how I can correlate moves in those currencies with what I'm seeing in commodity markets or other markets, and hopefully I can develop a system to draw inferences across markets to be able to better time my spot currency trades. But as it is right now, my euro US dollar futures are hedged. Corn futures are hedged. We've got a straddle. Nope. Scrap that. I've got a strangle on the 10-year. I've got a strangle on gold, and I've got a strangle on the SPY. So looking forward to seeing how markets mature and evolve over the Asian and European sessions. I usually have to get up fairly early, so I typically try to get to bed fairly early. So I'm interested to see by the open of London how these markets hold up. So I'll keep everybody updated as to any trading decisions I make going into tomorrow. And on that note, if anybody has any questions, comments, or concerns, you can always reach out to me at contact@runthenumbers.biz. That's contact at runthenumbers.biz. And I will try to get back to you before the next episode, or best case scenario, I may attempt to answer your question during the next episode. And on that note, happy trading, everybody. When in doubt, take profits, and talk to you soon.